Welcome to The Explainer. I'm really excited to dive into today's analysis with you. If you've been watching the financial markets at all lately, you've definitely noticed one asset class just absolutely crushing it. We're talking smashing records left and right, and yep, that's gold. So you're probably sitting there wondering, okay, what's the smartest way to actually get in on this action? Well, today, we're going to break down 5 distinct ways to invest in gold for 2025. We'll look at the hard data and figure out the ultimate strategy here. Let's get right into it.
27%. That's the staggering return gold has delivered in just the past year alone, according to our source data. Think about that for a second. While other markets have been dealing with all sorts of volatility and uncertainty, gold has just surged. It's catching the eye of pretty much anyone looking for a solid place to grow their wealth. But hey, before we figure out exactly how to buy it, we kind of need to understand why it's doing this in the first place.
Financial experts usually recommend gold for 2 massive reasons: diversification and as a huge defense against inflation. To put that into perspective, let's look at 1990. Back then, the value of 1 kilogram of gold could buy you a Maruti 800, just a standard, modest family car. Fast forward to today, that exact same kilogram of gold holds enough value to buy you a high-end luxury SUV. The physical metal itself didn't change at all, right? But its purchasing power scaled massively against inflation. That right there is the true power of gold.
So here's our roadmap for today's explainer. First, why invest in gold? Second, physical versus digital. Third, ETFs and mutual funds. Fourth, sovereign gold bonds. And finally, the 2025 verdict.
Section 1. Why invest in gold? Diversification and inflation defense.
Okay, let's look at the numbers. If you had purchased 10 grams of gold back on October 31st, 2016, it would have cost you 30,500 rupees. Exactly 8 years later, on October 31st, 2024, that exact same 10 grams was priced at 87,500 rupees. That translates to an incredible 13% compound annual growth rate over the last 8 years. It's consistent, it's powerful, and honestly, it makes gold impossible for a serious investor to just ignore.
Section 2. Direct access, physical versus digital gold. Let's impartially weigh the pros and cons of these direct access methods. With physical gold, like bullion or jewelry, you're getting hit with a whole barrage of extra costs. You've got a 3% GST, unavoidable making charges, and then there's the ongoing nightmare of storage costs, like paying for a secure bank locker. Plus, it earns absolutely zero interest while it's just sitting there, and selling it, not exactly an instant process. Now, on the other hand, we have digital gold, which you buy through various apps. This totally solves the storage problem. Zero locker fees, no making charges. Sounds great, right? Well, the data highlights 2 severe drawbacks. First, it is entirely unregulated. Second, and this is huge, there's a massive spread between the buying and selling price. The second you buy it, the selling price drops significantly, so you're basically taking a loss from day one.
And we also have to consider the barrier to entry. To buy a meaningful piece of physical gold jewelry, let's say a 45-gram chain, you're looking at a minimum upfront investment of around 400,000 rupees. That is a massive chunk of capital. Digital gold swings entirely the other way. You can start with literally just 1 single rupee. It's incredibly accessible and highly liquid through those apps. But, as we just talked about, that accessibility comes with the heavy costs of those unregulated buy-sell spreads. So really, neither direct option is perfectly ideal for a pure investor.
Section 3. Market-linked options, ETFs and mutual funds.
So you're probably thinking, can we get the benefits of gold without the physical storage headaches or the digital spread losses? The answer is yes, we definitely can. Gold ETFs are essentially paper gold, and they bring some fantastic benefits to the table. First off, high liquidity. You buy and sell them right on the stock market, just like regular shares. Second, unlike those digital gold apps, ETFs are highly regulated, so you get tremendous safety there. Third, the minimum investment is beautifully low, sitting right around 50 to 100 rupees. And finally, they perfectly track the underlying gold prices, either by holding physical gold in secure vaults or by investing in gold manufacturing companies. You do pay a small annual expense ratio, usually between 0.5% and 1%, but you completely skip the GST, the locker fees, and those massive digital spreads.
Now you might be asking yourself, wait, what about gold mutual funds? Well, as the analysis points out, a gold mutual fund is essentially just a shopping cart that buys gold ETFs on your behalf. But because the mutual fund manages that ETF buying for you, they charge an extra 1 to 2% expense ratio right on top of the ETF's existing fees. That double layer of fees eats directly into your returns. And on top of that, the tax rules are different. If you sell an ETF within a year, it's taxed at your marginal rate. But for a mutual fund, you have to hold it for over 2 years to escape that short-term marginal tax bracket. So sure, the mutual fund adds convenience, but it comes at a pretty significant cost to your actual overall profits.
Section 4. The wild card. Sovereign gold bonds, or SGBs.
The SGB was an initiative launched by the government of India, and its life cycle is genuinely fascinating for an investor. Let's walk through how this works. Step 1. You buy the bond at a gold rate officially set by the government. Step 2. The government actually pays you an extra 2.5% interest every single year just for holding on to it. Keep in mind, physical gold pays 0 interest. Step 3. You hold the bond for its full 8-year maturity term. And Step 4. The grand finale. When you redeem it after those 8 years, you get the current market value of the gold, and every single rupee of your capital gains is 100% tax-free. You're getting the price appreciation of gold plus annual interest minus all taxes. It is an incredibly effective investment vehicle.
But, and this is a massive but here, the government actually halted the supply of SGBs. The last issue was way back in February 2024. Why? Well, because the scheme was almost too successful for the investor, which meant it was a heavy loss for the government. Because the price of gold skyrocketed so intensely, the government found themselves having to make massive effective payouts of around 15% to bondholders. They just didn't anticipate gold rising this fast, so they hit the pause button. So as of right now, you cannot easily get your hands on a new SGB.
Section 5. The ultimate strategy for 2025. All right, so based on the cold hard facts, where should you actually put your money right now? Here is the definitive verdict summarizing our entire analysis. Physical gold? Keep it strictly for ornamental value. Seriously, buy it only if you're actually going to wear it. Do not buy physical bullion for pure investment because of all those heavy hidden costs. Digital gold? The source data says to avoid it completely. Its unregulated nature and those massive buy-sell spreads pretty much guarantee you're losing money up front. Sovereign gold bonds? Absolutely buy them. For sure, if the government ever launches them again, because the data shows they are highly lucrative. But since they're paused right now, gold ETFs stand clearly as the best active choice.
And that brings us perfectly to the bottom line quote from our source analysis. For 2025, gold ETFs are the most efficient way to invest in gold. They offer high liquidity, 0 storage headaches, really low minimums, and strict market regulation. You entirely bypass the double fees of mutual funds, and you don't have to sit around hoping the government decides to release a new batch of bonds. If you want to capitalize on the incredible momentum of gold right now, ETFs are hands down the smartest, most accessible path forward.
But hey, before we wrap up this explainer, I want to leave you with one final provocative question. We've seen gold's massive 27% run, but what about silver? The silver market has been absolutely surging recently too, and a lot of analysts are starting to wonder if silver might actually outpace gold in the coming year. Is silver the real hidden gem for 2025? If you found this breakdown valuable and want us to dive into the data-driven truth about silver next, definitely let us know. Keep learning, keep investing smart, and thank you so much for joining me on this explainer.